Hey, Saretsky here. As always, Canadian real estate market update, with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. Some big announcements this week from the U.S. Federal Reserve, economic growth, big moves in interest rates. Of course, all of this which impacts Canadian housing, which we're going to get into. But let's start it off with the obvious one, which is the U.S. Federal Reserve, the world's most important central bank, raising interest rates by 75 basis points. Of course, this was already priced in. We already knew that they were going to raise rates by 75 basis points. I think what's more interesting, the takeaway from this, is the comments from the U.S. Federal Reserve, Jay Powell, who basically came out and said, "Listen, we're going to remove forward guidance. We're no longer really going to give you guidance and tell you what we're going to do moving forward on interest rates, but we're going to be data dependent." Now, the question really, as Market said, it was like the interpretation was, well, what does data dependent mean? Does data dependent mean, hey, look, economic growth is contracting significantly. We're going into recession. We're actually already in one. That the Fed is going to have to pause, because that's historically what they've done. Historically, every time growth has weakened, the Fed has hit pause despite high inflation. And yes, that was the exact case in the 70s. They were cutting rates when inflation was north of 5%. Now, again, I'm not saying that is going to happen, but we're certainly going to find out. That's what the bond market believes. But what we had was, again, a rally in equities, a rally in the bond market, which means that yields fell down, right? When yields fall, the bond price goes up. So we had yields falling, equities rising, and a huge rally this week after the Fed, because the interpretation of this was that growth was slowing and the Fed was going to back away. Now, it's not to say that they're going to be cutting rates, but it certainly seems the pace of rate hikes moving forward is going to be much slower, and perhaps they may be done very, very soon, which of course I'm going to get into and provide some of my comments. But I think the important takeaway here for Canadians is the move in the bond market, right? The bond market basically led the way on the way up. They actually did most of the tightening for the central banks. Bond yields went way up to adjust for the rampant inflation. This tightened financial conditions and obviously the bulk of the slowing in the nation's housing markets. And of course, now you're seeing a reduction in these in these interest rates. So you're seeing the bond market saying, hey, listen, growth is going to slow significantly. We just actually had back-to-back quarters of negative GDP in the United States. That is the definition of a technical recession. Now, again, we're not calling it a recession. The White House came out and everybody came out and said, hey, well, listen, we haven't officially declared a recession. Just because we had two back-to-back negative GDP prints doesn't mean everyone's pulling out the textbook and arguing about what is an inflation, what is a recession, and what isn't a recession. I mean, at the end of the day, what the takeaway here is growth is slowing materially, and it's probably only going to continue to slow, given the fact that it takes time for interest rates and the moves from the Federal Reserve and the Bank of Canada to actually filter through the real economy. So I think slower and weaker growth is here to come, and probably a deepening recession in the months ahead, which could very well, again, prompt the central banks to hit pause. But we've seen that move now in the bond market. The Canada 5-year bond, which is really the most important metric, I would say, in Canada, right? A highly levered nation, especially for households. The vast majority of households borrow at that 5-year rate. So we really just have to watch the Canada 5-year bond. It's now down 100 basis points from its peak in the middle of June, just a month ago. So you've got the Canada 5-year bond now at just over 2.6%, down from 3.6. I mean, a 100 basis point move in 4 or 5 weeks is an unprecedented move. So the bond market smells something, and obviously it's much weaker growth despite inflation where it's at. So the question now moving forward is, how are central banks going to react to the incoming inflation and economic data? At what point, remember, the central banks are political entities. Despite what everyone tells you and saying that they're independent, that they only have an inflation mandate, I think that's completely false. I think that they are political entities, and I think at some point we had the argument was inflation it's too hard to bear. You got to hike rates. What are you guys doing? You waited too long. Governments were upset. There's that political pressure to hike rates, and I think now as the economic data comes in, and you see that, hey, we are in a recession, growth is slowing, people are losing jobs, at what point does the political pressure come back at these central bankers and saying, what the hell are you guys doing? And so, again, keep in mind the central banks are always 2 steps behind. So to suggest that we're going to have rate cuts any month now or 3-4 months from now, I think is naive. I think that what's going to happen is that, you might get another rate hike. You might even get 2 more rate hikes, but they're going to have to hit pause. They're going to then go from sort of pause to on hold to, what markets are pricing in next year is cuts. The markets are pricing in interest rate cuts from the central banks. And I personally, I'm going to go with the markets on this one. I think that growth is slowing materially. So let's watch. Let's watch what this means for the Canadian housing market. Obviously, we haven't yet seen a reprieve in fixed rate mortgages yet. So what's happening is, again, and we've talked about it in the show, I don't know, for 5-6 years now, right? Which is banks will give you an umbrella on a sunny day and they'll take it away on a rainy day, which means that right now they're not giving back the discounting that the bond market is giving. So right now, for example, RBC's special offer 5-year fixed rate is now 300 basis points above Canada's 5-year bond yield. Historically, the spread is about 160 basis points. So there's a 300 basis point spread. It's normally 160. So the banks such as RBC aren't actually reducing yet their fixed rate mortgages, capturing that spread, because this is a risk off environment. The banks are pulling back. The banks are aware. We just had last week, RBC just said we're going to have this historic correction in the Canadian housing market, that prices are going to decline more than they did during the financial crisis here in Canada in 08-09. So naturally, what are they doing? Well, they're like, hey, let's bake in a larger spread. Because we're going to be issuing less mortgages and we want to be conservative in this environment. So again, banks always tighten credit in bear markets. It's part of what creates the bear market that feeds on itself. And it's the same thing in the bull market, right? Like, why? Think about this. Why in a bull market, when you're out there buying for a house and you're paying $300,000, $400,000 over the asking price, did the appraisal always hit? Why do the banks never question the valuations in the bull market? Because in a bull market, it's game on. The banks want the business. The banks create the boom, and vice versa. The banks create the bust. And I think we're seeing that right now in their extremely conservative spreads. So that's something to sort of keep an eye on, that despite the decline in the Canada 5-year bond, we might not see as much discounting as we historically would in a more normal balanced market. The next thing to keep in mind is that the markets are still pricing in a 50 basis point rate hike from the Bank of Canada in September. So great chart here from, again, my good pal, Rob McClister. Highly encourage you to go check out his newsletter. But basically showing that assuming we do get another 50 basis points in September, that would reduce the typical purchasing power. You've lost about 11.8, almost 12% of purchasing power since the last rate hike, basically since since June. So this assumption looks at assuming you may have a $100,000 household income, 20% down payment, 30-year amortization, you'd be able to qualify. Back in June, you were qualifying for $598,000. Today, as of September, you'll qualify for $527,000. So you have to ask yourself now, what does this do to, again, purchasing power in the housing market? If people can't qualify for much, prices have to come down. So I'll give you one, I think the most important metric I can give you today is the affordability metrics in Canada. So everyone's looking at it and saying, what's happening with mortgage rates? How much do prices need to adjust to offset the increase in rates? So what I did is you go back and you can run a simple mortgage calculator. So house prices would need to drop about 25% in order for mortgage payments to basically be as affordable as they were at the peak of the market earlier this year. So for example, if you assume $1 million, if you assume $1 million purchase and you put down 20% down payment, so you borrowed 80% of it on a 30-year amortization. So $1 million house, you put down 20%, that would require an $800,000 mortgage. At 2.5%, a mortgage rate, that would be a $3,156 payment, $3,156. With 600, now if the price drops 25%, that means you now have to have a $600,000 mortgage, but you're borrowing at 5%. The payment is $3,200. So it's basically the same. So prices essentially, if we could draw a straight line and say, well, how much does it need to adjust? It would need to adjust about 25%. Now, again, obviously things aren't that simple. Rates can drop, as we just saw. Rates of the bond market has come off 100 basis points. So the key thing here, ultimately, as I've talked about it before, is in a highly levered housing market, the thing that you need to watch is borrowing costs. That's really all you need to focus on. I think central banks, again, are operating a switch. Okay, they're operating a light switch, on, off. So that's the economy. Either they're stimulating and things are on, or they tighten financial conditions and economy off. They are not producing a dial where they can just sort of manipulate markets and just have the right temperature. It's economy on, economy off. And so all you have to do is look at what's happening. We have the early data here in July. Greater Vancouver home sales will come in. They will come in. You can mark this. Go tell your friends here. You got the early release on the data. July home sales in Greater Vancouver will come in at a 20-year low for the month of July. And I believe it's going to be the same in the GTA as it has been the last several months. So again, when you say, well, wow, Canada's two largest metropolitan housing markets are both witnessing 20-year low in home sales, not adjusting for population growth and not adjusting for the increase in housing stock. I mean, that's a pretty substantial change. Would you not say that's economy on, economy off? And so, again, this is the game. It's not just about over-indebted households. It's over-indebted sovereigns. It's a global economy that is choking on 365% debt to GDP. So as always, hope that helped. Take what you will. Enjoy your summer, and we'll see you soon.